All right, welcome to BAF 3M1 Introductory Accounting. All right, today being the first day, I apologize for the fact that there's so many definitions, but you're going to need these definitions in order to move forward. So we're going to get started. Okay, accounting is basically the process of gathering, recording, organizing, and analyzing financial data for decision making. So it's basically GROA. G in gathering, R in recording, O in organizing, and A in analyzing. So GROA. So basically, you have to gather the information, put it down on paper, organize it in a way that people are going to understand it, and then analyze that information to make good business decisions. So take advantage of positive trends and minimize negative trends. Now, another important part of an accountant's job is to establish what's called a system of internal control. Now, internal control are rules and procedures for making sure that the financial statements that he or she's preparing are accurate, and to also protect the assets or the business's property. Now, accounting is often called the language of business because it's the same all over the world. Okay, it doesn't matter what country you're in, the principles of accounting are going to stay true. Now, the basic accounting form is called the balance sheet, and as the name implies, it balances. So there's a left side to the balance sheet and a right side. So the left side has to equal the right side. Now, a balance sheet lists three things. It lists the assets, the liabilities, and the owner's equity of a person or a business at a particular point in time. Now, let me show you a balance sheet. All right, so here's an example. So at the top of the balance sheet, three questions are answered. Who, what, and when. So who is the name of the company, what is the name of the financial statement, and when was it produced. Now, as the definition indicates, a balance sheet lists the assets, the liabilities, and the owner's equity of a person or a business at a particular point in time. Now, assets are things of value that the company owns. Now, things like cash, things like supplies, land, building, fitness equipment, accounts receivable, those are all assets. Those are all things that the business owns. Accounts receivable is an account that records amounts that are owed to the business by others. So, now, liabilities, on the other hand, are the debts of the business. Okay, things that the business owes to others. So accounts payable are amounts that we owe our suppliers, let's say. So currently we owe $4,000. Bank loan for $69,000 and a mortgage for $80,000. So those are totaled up for $153,000. Now, owner's equity is also known as capital, or a person's capital, or owner's equity, is their net worth. So owner's equity really is the value of the business to the owner. Okay. Now, when you complete a balance sheet, the assets are not simply thrown down. Okay, there's an order to them. So first, we list our liquid assets. Those are the assets that are easily converted into cash. So cash is already cash. It goes first. Accounts receivable is almost cash. Okay. It'll take roughly 30 days to 120 days to convert it into cash. And then supplies. Supplies are relatively liquid. We can sell them fairly easily. Then we switch over to our larger items. Now, our larger items are listed according to useful life. That means how long we're going to have them. So land will probably have the longest. So it goes first. Then building. Then fitness equipment or truck, okay? And then we have total assets. So they're all added up. Now, liabilities, on the other hand, are listed according to when they have to be paid. So accounts payable has to be paid between 30 and 120 days. bank loan 1 to 5 years, and then mortgage anywhere from 5 to 35 years. Okay? Now, when you complete a balance sheet, here's the trick. Okay? Put in these 3 titles, then complete the asset side, but don't put down your total assets. Leave it blank for a second, then go back to the right hand side and complete that side in its entirety. Then you'll know what line this last line is on. So it's nice and square and even. So then finally go back and put your total assets, and it should balance. So you'll notice that total liabilities plus owner's equity equals 247, which is your total assets as well. All right. Now on the balance sheet, a single line, okay, here, indicates that addition or subtraction is taking place. A double underline indicates it's a total, and you'll notice that not every number has a dollar sign. Only the first thing being added up gets a dollar sign, and then subtotals and final totals. So you'll notice that this 6,000 has a dollar sign, and then the total has a dollar sign. Here, the 4,000 has a dollar sign, then 153,000, because it's a subtotal. It's going to be used, this plus this is this, so it becomes the first thing being added up again. So only the first thing in each column of numbers that's being added up, subtotals and final totals, get dollar signs. All right, moving along. All right, so we talked about that. Now we say that owner's equity is a residual claim on the assets of the business, and it's called a residual claim because the owner's entitled to the residue, or what remains of the assets after all the liabilities have been paid, right? So he gets whatever's left over. Now let's look at the basic accounting formula, which is on the balance sheet, right? So assets, total assets, is equal to liabilities plus owner's equity. So that's the basic accounting equation. So let's assume that the business obtains a bank loan with $100. The business's assets are going to go up 100, correct? Because now we have $100 cash, and the liabilities are also going to go up, okay? Because now we owe $100 to the bank. Now the second one, we see that $200 is put into the business by the owner. Now the cash is going to go up, right? So cash goes up 200, but the value of the business went up as well, because whenever the owner gives the business something, owner's equity is affected. There's a rule in accounting called the business entity principle, and it is a GAAP, a generally accepted accounting principle that states that the business is an entity unto itself. That means that a business is a separate person from the owner, and that the financial data of the owner and the business should not be combined, right? So if the owner gives the business $200, the business's cash goes up, and now the value of the business also went up, okay? So you'll notice that the left side equals the right side again. All right, so in accounting, sole proprietorships and partnerships are governed by GAAPs, generally accepted accounting principles, and they're set down by the Canadian Institute of Chartered Accountants. Now, corporations, on the other hand, are governed by international financial reporting standards, okay, and they're set out by the International Accounting Standards Board. And they're very close to the same, but they are different in some respects. All right, so we talked about the business entity principle. Now, there's also a rule in regards to putting assets on your balance sheet. When you record asset on your balance sheet, you have to record it at the acquisition cost, not the market value. So you have to record it at what you paid for it, not necessarily what you could sell it for. Okay? Even though the owner may think that that asset may have increased or decreased in value. Now, another gap is the going concern principle, and that just assumes that the accountant has to assume that the business is going to continue into the future, unless it is not. That's why assets are not listed according to what we could sell them for, because we're making the assumption that we're going to continue to use them to conduct business. There's also something called the going concern, or the principle of conservatism, and that basically says that the accountant has to be fair and reasonable when making estimates or evaluations, and that's to protect investors. So as the accountant, the accountant can't overstate or understate financial figures. Now, I talked about single ruled line and double ruled lines. Okay. Now, in this class, you're not going to be able to use erasers or pencils or liquid paper. If you do, you're going to lose a half mark for each time you do that. Now, how do you make a correction? You put one line through your mistake, and you initial your mistake, and you put the correct answer above it. Okay. Now, when you come to class for the first time, I'll show you how to use the accounting paper. All right. Other things you can't do are cursive write as well as abbreviate. Okay. Now, a couple other definitions. A creditor is a person to whom we owe money, and a debtor is a person who owes us money. Now, remember, accounts receivable is recording amounts owed to us, and accounts payable is recording amounts we owe to others.